All right, time for some business news now. Kenya's edible oil bill is on the rise. Now, imports hit 26 billion shillings in the quarter to June, driven by higher global prices and changing consumption patterns. Volumes of edible oil imports rose slightly from 182,209 tons in 2024 to 183,139 tons in 2025. But the total import bill jumped by 1.64 billion shillings from 23.97 billion shillings in 2024 to 25.61 billion shillings in 2025, an increase of 6.8%, driven by higher global prices and a shift toward refined products. Palm oil volumes dipped slightly from 172,174 tons in 2024 to 168,418 tons in 2025. But costs rose to 23 billion shillings from 22.22 billion due to global supply shortages. Soybean oil imports dropped sharply from 2,451 tons in 2024 to 1,671 tons in 2025 in volume, and 767 million shillings to 252 million shillings in value. Thanks to higher local production, sunflower oil more than doubled in volume, recording an increase from 1,773 tons in 2024 to 3,909 tons in 2025, and 290 million shillings to 610 million shillings in value, reflecting growing demand. Central Bank of Kenya on Tuesday slashed its benchmark lending rate by 25 basis points to 9%, marking the 9th rate cut in a row as it tries to stimulate bank lending and support economic growth. At 9%, the central bank rate, a key signal in the pricing of loans, is at the lowest level in about 3 years, having stood at 8.75% in January 2023. The reduction in CBR is in line with the wishes of commercial banks. Through Kenya Bankers Association, lenders had urged for a reduction in CBR to help lift the pace of private sector credit growth and reduce loan defaults. Meanwhile, the increased popularity of special funds has diluted the dominance of money market funds as investors pivot to the higher yielding class of unit trusts. Data from the Capital Markets Authority shows the proportion of MMFs as a share of total pooled investor funds dropped to 58.9% in September 2025 from 62.2% a year earlier. The dilution of assets under MMFs has coincided with the rising popularity of special funds, whose share rose to 20.3% in the review period, crossing the 20% mark for the first time.